This conversation is powered by Google Illuminate. Check out illuminate.google.com for more. Welcome to this discussion on a fascinating piece of legislation, Section 13A, Discount of Agricultural Paper. It's a cornerstone of the Federal Reserve Act, and understanding its nuances is key to grasping the Fed's role in supporting the agricultural sector.
Indeed. This section, while seemingly specific, reveals a great deal about the Federal Reserve's broader mandate and its historical evolution. It's not just about discounting paper, it's about managing risk and fostering economic stability within a crucial sector of the U.S. economy.
Exactly. It's a window into the Fed's power to influence credit markets and, by extension, agricultural production. Let's start with the core function. What exactly does discounting agricultural paper entail?
At its heart, it's about providing liquidity to agricultural businesses. The Federal Reserve banks can discount, essentially, lend money against notes, drafts, and bills of exchange related to agricultural activities. This helps farmers and related businesses access credit when they need it most.
And this isn't just any lending. It's done under specific conditions, right? What are some of the key limitations and regulations?
Absolutely. The eligibility criteria are quite specific. The paper must be related to agricultural purposes, livestock, and have a maturity of no more than 9 months. There are also stipulations regarding collateral for longer-term notes, often requiring warehouse receipts or chattel mortgages. The Board of Governors sets these regulations to manage risk.
So the Fed isn't just handing out money. It's carefully assessing the risk associated with each loan. This speaks to the importance of responsible lending practices, even within a supportive framework. What about the role of member banks in this process?
Member banks act as intermediaries. They endorse the agricultural paper before presenting it to the Federal Reserve Bank. This endorsement essentially guarantees the loan, mitigating risk for the Fed. It's a crucial element of the system.
The section also mentions rediscounts for federal intermediate credit banks. Can you explain that?
Yes, this expands the reach of the program. Federal Reserve banks can rediscount notes from these credit banks, further channeling credit into the agricultural sector. This is a crucial layer of support, especially during times of economic stress. The section also allows the Fed to buy and sell debentures issued by these credit banks, providing another avenue for liquidity.
It's a multi-layered system designed to ensure a consistent flow of credit to agricultural businesses. This highlights the Fed's role not just in monetary policy, but also in supporting specific sectors of the economy. What about cooperative marketing associations? How does the Act address them?
The Act explicitly recognizes the role of cooperative marketing associations. It clarifies that notes issued by these associations for agricultural purposes are eligible for discount. This is a significant inclusion, recognizing the importance of these cooperatives in the agricultural landscape.
The section concludes with limitations on the amount of discounted paper, particularly for longer-term notes. Why are these limitations in place?
These limitations are crucial for risk management. The Board of Governors can set percentage limits based on the Federal Reserve Bank's assets. This prevents excessive exposure to any single sector and maintains the overall stability of the financial system. It's a vital safeguard.
So it's a delicate balance between supporting the agricultural sector and maintaining the overall health of the financial system. The Board of Governors plays a critical role in this balancing act. What's the significance of the board's regulatory power in this context?
The board's regulatory power is paramount. They set the rules, ensuring the program operates effectively and safely. They define eligibility criteria, maturity limits, and risk parameters. This oversight is essential to prevent abuse and maintain the integrity of the system.
This section of the Federal Reserve Act has a rich history. How has its relevance evolved over time?
While the core function remains the same, providing credit to the agricultural sector, its importance has fluctuated with economic cycles and agricultural trends. During periods of economic hardship, its role in stabilizing the agricultural economy becomes even more critical. Today, it continues to be a vital tool, albeit within a more complex and interconnected financial system.
So while the language might seem dated, the underlying principles of providing liquidity and managing risk remain highly relevant in today's financial landscape. It's a testament to the foresight of the Act's framers. This discussion has highlighted the complexity and importance of Section 13A. It's more than just a technical provision, it's a reflection of the Federal Reserve's commitment to supporting a vital sector of the U.S. economy while maintaining financial stability.
Precisely. The section's detailed provisions, its emphasis on risk management, and its adaptability over time demonstrate the enduring relevance of its core principles.
That was a great discussion. Thank you for your insights.